Hello, everyone. As we're start, so welcome to our Phillip Securities Research Morning Call. It's been a really packed week, so we got quite a bit of content. We got Netflix, Adobe, Tesla, quite a bit of Phillip on the ground. We also got Suntec REIT, OUE REIT, Keppel Ltd, as well as our usual SG Weekly and technical analysis. So we're gonna jump straight to it. So just a usual disclaimer. So everything is only for educational purposes. So the first one, Netflix. Netflix, we think it's gonna be a pretty interesting stock to look at if you wanna focus on stock that can actually withstand recession. So take a look at their result. Their first quarter revenue was in line with our estimate. PAMI outperformed a little bit due to better monetization and favorable timing of expenses. So their first quarter revenue and PAMI were at 24 and 26% of our forecast. Their revenue growth was 13% year on year. It was driven by higher subscription and their recent price adjustment. They increased the standard plan by 16% and the advertisement plan by 14%. They've also been doing really well in their ad-supported business. So moving on to their positives, I guess the thing that people focus the most now is whether they have a huge impact from the economic downturn. It turns out they don't. So we did a brief research on how they historically do. So historically, they actually show resilience during recession. We think it's because consumers saw it as a low-cost entertainment alternative compared to going out, traveling, or just going to the cinema. So during the 2008 financial crisis, their share price actually went up 125% compared to Nasdaq, which went down 7%. And Netflix themselves, they're also saying they're seeing minimal impact from market volatility. They're seeing continued strong retention and engagement. And their guidance for the next quarter is also very positive. They've guided 15% year-on-year revenue growth, driven by the ongoing effort of their recent price increase and their continued membership growth, and also the scaling of their advertisement business. We see their advertisement business is actually a sweet spot for them because it's something that they recently roll out where you can still watch the movies, but at a cheaper price. At the cost, you're gonna have to watch the advertisement that came before the content. So that plan is starting at $7.99 per month, which is very cheap. So that kind of provide like a further downside protection for them. Moving on to the second positive point, we think they're really exhibiting really strong pricing power. So in the beginning of 2025, like I mentioned just now, they raised their price. It's not impacting their strong retention at all. They didn't really provide a number, but management stressed on the fact that it didn't affect at all. So this kind of highlight its strong pricing power and market leadership despite the market downturn. So the way Netflix price their membership is they usually enhance their content quality and then gauge the user stickiness. When they feel like the user is sticky enough, they're going to adjust the price upwards. And they have a lot of major content lining up for the rest of the year. The Tyler Sereno fight, the NFL Christmas game, all line up. So we think further price hike remain likely, even amid the market volatility. We expect the increased pricing to contribute to around 2% of their revenue growth. And last but not least, their advertisement business remain very attractive. They have actually stopped reporting their quarterly subscription number because now they shift their focus towards advertising as a key driver of their future profitability instead of just subscription. And they recently launched the Netflix ad suite in April, and this will boost their ad ROI and operating margin, which grew 3.7% year on year in the first quarter. So the company expects ad revenue to double in FY25, and we expect the ad business to contribute around 3% of the overall revenue growth. And moving on to guidance, they have guided $11 billion in revenue for the next quarter, which is 15% year-on-year growth. So this is supported by their increasing membership base and also prices. They expect their operating margin to increase 6.1% to 33.5% on higher operating leverage. So we think Netflix, they remain resilient with limited tariff exposure, very strong earnings, and it's backed with a very optimistic FY25 outlook. Their management aim to double their advertising revenue in FY25. Actually, recently there was a leakage of their internal discussion. They actually have a long-term goal of doubling their total revenue by FY30. So that implies a 15% CAGR, which we think is pretty strong given the current environment. So the company remains its leadership really in streaming. It's reinforced by its very notable pricing power and improving margins. And right now they only have less than 10% of share of total TV view. So we believe there is a runway for growth. But they're currently trading at 37x FY25 PE ratio. This is very well above the industry average, which is only 17x. So within the current valuation kind of suggests very limited near-term upside. So in terms of valuation, we raised our FY25 revenue and PAMI by 1% each to account for their gradual price increase and thriving advertisement business. We raised the terminal gross from 3% to 3.5% because of their advertisement business. We think it's a long-term monetization potential. We raised our DCF target price to $950 from the previous 870, and we upgrade from reduced to neutral. So that's all from me. I'll pass my time to Fami.
Thank you, Elena. Good morning, everyone. I will present an update for Adobe, an iteration to the company investment thesis, which is titled Stability Amid the Market Uncertainties. So next slide, thank you. For the first investment highlight, we think Adobe is the industry-leading cloud in the creative industry. We believe Adobe's creative cloud dominates over 80% of the graphic design market in 2024. Meanwhile, its document clouds Acrobat reaching approximately 650 million monthly active users in 2024, which was up by 23% year-over-year basis. This helps drive users acquisition through its freemium model and frictionless onboarding. We think Adobe is well positioned to capture the total addressable market projected to reach $293 billion by 2027, fueled by rising demand for creative and personalized content. Next, we find Adobe to have a robust recurring revenue, delivering a substantial and predictable revenue stream. If you look to the chart on the right side, we could see Adobe's subscription revenue has always remained above 90% of its total revenue and stands at an impressive 95% for the financial year 2024. In addition, the remaining performance obligations reached $19 billion in first quarter 2025, which was up by 16% year-over-year, this signaling strong forward demand. High recurring revenue support Adobe high gross margin over the last 5 years, which remain above 87% and stand at 89% in the financial year of 2024. Finally, Adobe is monetizing AI capabilities across its cloud offering by leveraging on its large customer base. Adobe has generated over $125 million in its direct AI annualized recurring revenue in the first quarter of 2025 through its AI-first products such as Firefly and Acrobat AI Assistant, and the management target to double this figure by the end of 2025. We see ample room for deeper AI integration across Adobe's large subscription revenue, and this include its 750 million digital media monthly active user and 22,000 of enterprise customer. As for the outlook, Adobe reaffirmed its guidance for the financial year 2025 during its first quarter of 2025 result, targeting total revenue growth of 9% year-over-year. The digital media segment's revenue is projected to grow by 10% year-over-year, and we expect this to be driven by the broad-based adoption across Adobe's product portfolio, particularly new offerings like Firefly, rising One Adobe deals, and growing base of web and mobile users. We think Adobe's AI monetization is larger than it seems, with $3.5 billion of the annualized recurring revenue was influenced by AI already. We see slow and steady AI growth for Adobe, and we think features like Firefly are already driving values across the cloud offerings. On the tariff, we see minimal impact from tariff on Adobe, given its focus on digital products and services. As Adobe does not sell physical goods, we think it is less exposed to trade restrictions that typically affect manufactured items. To summarize, we upgrade to buy recommendation and raise our DCF target price to $543 due to the recent share price performance and after rollover an additional year of valuation. We find comfort and stability from Adobe through its strong earnings growth and robust recurring revenue model. That is all from me. I will hand over to Glenn. Thank you.
Yep, thanks, Fahmi. Yep. So for we have Tesla's first quarter results. it was a bit of a disaster results for them. It came in below our expectations. I think our forecast was a bit too high, a bit too optimistic. So the first quarter revenue and adjusted PATMI only came in at 17% and 12% respectively of our forecast. The only positive we could see from their results in the first quarter was that their non-auto or non-car revenue was the only figures that grew. Yeah, so it's quite funny for a car company. Their energy storage was up 67%, which was still quite good. And their services revenue was also up 15%. However, if you look at the total, it only makes up such a small amount of the total revenue, only at 28% of total revenue. Yeah, look, in total, their non-auto revenue was up 37%. So now on to the negatives. The first one and the biggest one, I think, would be that they recorded a record year-on-year decline in their deliveries. So these figures were given before the results released, so we sort of expected it already. Their deliveries declined by 13% year-on-year, which is a record quarterly year-on-year decline. And it was down to 337,000. And this decline mainly came, or at least what they said came from this Model Y update that they had to do across all of their vehicle factories. So I think production went down and deliveries went down in line with the production. Those domestic China sales was actually up by 2% year-on-year. But then again, if you look at the China EV market, it was actually up 47% during that same period. So you can say that they are not really growing as fast. They also continue to lose market share to BYD. Now Tesla only has 7% of the market share compared to 10% a year ago, while BYD has a 22% market share. As for the margins, it has continued to decline again. Their gross margins were down 100 basis points year-on-year, mainly due to the lower average selling price from product mix as well as sales incentives and lower production volume, which I mentioned earlier, and the factory utilization rates. Higher operating expenses, which rose 9% year-on-year from the AI and R&D projects that they are trying to implement. I think it's mainly for their Optimus robot as well as the full self-driving. And lastly, the decline in auto revenue as well. So this is the lowest that the gross margins have been since second quarter of 2019. And last but not least, the last negative would be a nine consecutive quarter that we have seen their average selling price decline. So first quarter's ASPs were down 10% year-on-year. As for the outlook, they are finally less optimistic. In the last few quarters, although deliveries were down, they were still very optimistic. But now they are saying that they are warning that the evolving trade policies and the trade war will actually inject a lot of uncertainty into the automotive and energy markets, mainly by disrupting the supply chains and the cost structures for not only Tesla, but actually for all car and EV manufacturers. And they also didn't provide any 2025 guidance in this quarter, and they will only give an update in the next quarter, in second quarter. However, they still are quite positive on the full self-driving or FSD, as well as their automation and the robots, the Optimus robots, right? So they assured that they are on track to launch they have a pilot launch for their driverless ride-hailing business or Cybercab in Austin, Texas by June, so in a few months' time, as well as to initiate the production of the Optimus robots in California by this year or 2025. We view that their results were extremely negative, and we see that almost all line items were in decline, and also they have continued to lose market share to BYD in China, even though the market in China is actually booming and is still growing rapidly. And also that the Trump tariffs could also further hurt them, firstly by the removal of the EV tax credit, which could lower their demand. Also the tariffs, which would impact their supply chain and their business and profitability. So I think we estimate around 10 to 15% of a made in America Tesla is actually made in China. So this will come mainly from the batteries, right? Things that they can't produce in America. So that would cause an increase in the price. Yeah. So therefore, we are quite cautious on Tesla, and we do have a sell with a lower target price of $200. Um, and as for all the reasons that I mentioned earlier. However, if you follow Tesla quite closely, and I think there's also a question in the chat, in the Q&A, that I'll answer now, is that the share price has ran up quite high recently, and that's mainly due to two reasons. The first one is that Elon Musk did mention during the earnings call, that he would focus more on Tesla, right, as compared to the time that he has spent with Doge in the government and supporting Trump. So I think that's quite positive, and that has caused some positivity, mainly because if your CEO and your is the main person running the business is not around to run the business, I think they are quite directionless. So now that he's coming back, I think a lot of investors are thinking that this could be a positive, because he could finally, the captain is back at the wheel. And the second reason, that has seen some positivity for Tesla would be the government has, released some of the regulations surrounding the self-driving, the FSD or full self-driving in America. So that could prompt them to actually be able to roll this out faster. But then again, we believe that we only could see a significant revenue contribution from these sort of initiatives, like the full self-driving, robotaxi, and Optimus, in the next only 3 to 5 years. So, and we also believe that it has been priced in. Yeah, so that's all I have for Tesla. I'll now hand it over to Iqbal. Thank you.
Thanks, Glenn. We'll present on Sunny Environmental's Phillip on the ground. Recently, they had a corporate presentation. Yeah, so Sunny Environmental is an environmental engineering company. So they design and install mechanical equipment and also do some construction projects for PUB. 80% of their revenue comes from PUB. Yeah, so some examples you can see from the image. For example, they do auto control facilities for the wastewater processing plants for PUB, as well as another example is that they install and construct holders to combat rising sea levels, and it's also a PUB project. Yeah, so for their order book wise, the current order book is 252 million, so it's about 2 times their full year revenue. It's about a negative 20% year-on-year drop, because management guided that they did not take out many projects because they did a lot of project financing. And they did guide that there should be more order tenders this year, because a lot of their projects is coming to completion. And some of their industry drivers include the government's long-term plan to pump in 100 billion budget to combat rising sea levels over the next century. However, in the nearer term, PUB will construct a 20 km tidal gate and reservoir from Marina East to Tanah Merah, and we estimate this huge project to be about $3 billion, which we believe that Sunny will be able to benefit from as well. For the corporate presentation, Sunny did guide that they will have two new segments. One is for the manufacturing of magnesium hydroxide. So this chemical is used to treat wastewater, and they will bring in a margin of around 20% profit margin. They also have another new segment, which is the renewable energy. So this is a segment whereby Sunny will own solar panels and they sell electricity sell electricity in Thailand itself. Yeah. However, they still target about 75% revenue from their core business, which is to take in contract from PUB itself. Yeah, so our outlook for Sunny is that because Sunny Environmental have a strong track record with PUB, this should maintain visibility for future contracts, because they are a company which has been set up since 2006 and they are listed since 2017. So this long track record with PUB should enable them to easily score contracts from them as well. And we do think that the diversification to private sector should also help to increase its profit margins, because as you can see from the right side in the table itself, their gross profit margin now is only about 10%, because the profit margins from government contracts is not that high. Yeah, so we do think that the venturing into private sector, such as the renewable energy and the magnesium hydroxide manufacturing, should help with their profit margins. Yeah, next slide, please. Yep, I'll be presenting Phillip on the ground for SK Hynix as well. Next slide. So for those who are not very sure of SK Hynix, they are a memory chip producer. You can think of them as a competitor to Micron because they manufacture DRAM, NAND, and high bandwidth memory chips. For their revenue-wise, for the most recent quarter, they scored a plus 42% year-on-year increase in revenue. This is driven by Chinese subsidies for consumer electronics, as well as the strong sales of their high bandwidth memory chips and DDR5 memory chips. And there's also some restocking demand from the PC players. For their tariff impact-wise, they did mention that tariff presents a lot of uncertainty. However, their outlook remains unchanged. Some of their customers maintain their planned memory demand, and however, because of this tariff, some of them requested short-term supply pull-ins in order to expedite their demand. Because as we all know, because of the tariff, some of the end consumers, for example, Apple users, they will stock up on the Apple phones. Yeah, so this caused some of SK Hynix customers to request some short-term supply pull-ins. As for their guidance, SK Hynix did guide that high bandwidth memory demand is still strong, and the server market demand is still strong as well. And this is further fueled by the efficient open source model like the DeepSeek, which lowered the developmental costs. And this allowed more AI players to join in the demand as well. For the NAND segment-wise, their competitors are more conservative and some even cut productions. So SK Hynix did guide that the growth from the NAND segments will come more from the supply factors rather than demand. For outlook-wise, they did not provide any guidance. However, our outlook for SK Hynix is that we do think that there will be around 20% year-on-year growth expected for the second quarter. And this is because the AI demand is still fueled by the big CapEx guidance. Even though 20% year-on-year growth is quite impressive, however, as you can see on the chart on the right, this 20% it shows there's still a slowdown in terms of the pace of growth as compared to, for example, first quarter last year itself, where they achieved 144% year-on-year growth. Yeah. Next slide, please. Yes, I'll be presenting on Intel's Phillip on the ground as well. Next slide. Yeah, so for Intel, for their most recent quarter, they achieved $12.7 billion, and this is a flat year-on-year. And however, it did beat their guidance of $12.2 billion, and this is because they achieved a better than expected data center CPU sales and also higher customer purchase because of the anticipation of tariff. Yeah, for example, as for the different segments itself, their CCG segment, which represents the client computing group, as can be seen in the bottom right corner, it is down 8% because of competitive pressures, and this refers to losing market share to AMD in terms of the PC CPU chips. As for their DC AI segments, which is their data center and AI segment, it is up 8% year-on-year because there's increased hyperscaler demand for host CPUs for AI servers. And the foundry segment is also up 7% because of some pull-ins of Intel 7 wafers, which is the 10 nm chips. For Intel's guidance-wise, they guided the next quarter's revenue to be down 8% year-on-year because they expect the foundry to be down in the next quarter because of the pull-in of demand this quarter itself. Yeah, so next quarter there should be a slowdown in the foundry segment. And they also expect them to get hit by impact from tariffs which may cause economic slowdown as quoted from them. Yeah, so Intel is currently not doing well. So the management did new CEO Tan Wu did give some strategies in order to turn around the company. Firstly, the strategy is to lower their capex and also their opex, and they are planning to lower it quite a lot. As can be seen, they want to lower their opex by about close to 40%, and also their capex by close to like 20%. Yeah, so 20 to 30%. Yeah, so they did not really mention how exactly will they achieve these targets. They did mention that they will speak to internal teams and try to come up with solutions to cut costs from non-core assets. And we do think that they are moving in the correct direction, because, for example, recently they sold 51% of Altera for net cash proceeds of $4.4 billion, and they expect the deal to close in second half of 2025. And another example is because they have come up with plans to cut about 20% of their manpower. And I believe this is also from their non-core segments. Yeah, so we do think that they are moving in the correct direction. However, our outlook for Intel is still very negative because we do think that revenue will still continue to decline over the next few quarters because of losing market share, losing the PC CPU market share to AMD, which will drag down the consumer and computing group segment. And we do expect the effects of the turnaround strategy to only be noticeable after at least 1 year, because we don't think that this strategy will be it really depends on how well it is being executed. And I personally think that it will only be noticeable after at least 1 year. Yeah, so the recovery won't be so fast. Yeah. So that's all from my end. I'll hand over the time to Darren. Thanks.
Yeah, thanks, Iqbal. Yeah, run through some Phillip on the ground for some of the REITs who which we released their results last week. Yeah, so for Keppel REIT, basically their MPI, it was higher due to contributions from acquisitions of the 255 George Street, as well as higher occupancy at 2 Blue Street. And it was partially, DP was impacted by higher borrowing costs. So that was from the loans which were taken to finance the 255 George Street, and some of the refinancing of the existing borrowings at the current market rate. So as a result, their loans, you see the borrowing cost on the right side, it rose by 23%. Yeah, the cost of debt was stable and gearing also stable at 42%. Yeah, so for them during this quarter, they saw some dip in portfolio occupancy. So in fourth quarter, it was at almost 98%. Now it's at 96%. That's because one of the tenants, they pre-terminated the lease and they've moved towards the west side, one of the business parks there. So this pre-termination income is 100% of it is really inside this distributable income for this quarter. Yeah, so in the next few quarters, you'll see some weakness from there's a absence of contribution there. And for rental reversions for this quarter, it was 10.6%. So there is still some strong demand coming from technology, media, telecommunications, banking, insurance, and financial services. But across the board, all the office properties, like all the REITs that we attended the briefing, they mentioned that leases now are more shorter term. Like previously, when tenants, they used to secure like 5-year leases, now they're looking at 3 years. And also, basically, right now, all the tenants, there's still no tenants that are currently in distress or looking to downsize at the moment now. Yeah, and for Keppel lease, for Keppel REIT, basically their current market rents are higher than the existing rents of the passing rents of the portfolio. So there is still some potential for positive rent reversions. So they are targeting about a double-digit positive rent reversion for them. And the cost of debt guidance is likely to be around 3.5% for them. So it's similar quarter on quarter. And they also mentioned that the leasing market is very volatile for them. Like since the announcement of the tariffs, the demand quietened. But since then, over the past week, it has picked up. So it's really on and off leasing demand. And there is still a wait and see approach for taking on leases. And most leases are also now, the demand is for smaller spaces like 1,000 to 5,000 square foot. So larger leases still take a longer time to backfill. Yeah, and for now, the supply conditions for 2025, basically Keppel South Central, it TOP'd in February. So it's known to be about 50% pre-committed, as well as in under late stage negotiations. So other than that, Keppel South Central, there are no more incoming supply for the rest of this year for office. So as a result, we also saw during this quarter, the rents for core CBD graded office is now at $12.05. So it rose slightly from $11.95 in the previous quarter. Yeah, and basically for Keppel REIT, they also mentioned no direct impact from the tariffs, as tenants are not really export-import focused. So not much impact for them. And the outlook basically is still, like I mentioned, they're targeting high single digit to low double digit positive rent reversion, which is very possible as their existing rents, the passing rents are low $11. Well, like I mentioned, the market is already $12.05. Yeah, and the leases that they signed also in the first quarter were above that $12 mark. So those are some positive signs for Keppel REIT. Yeah, next slide, please. Yeah, so for CICT, this will release their first quarter update. Yeah, so for CICT, basically they are still 95% in Singapore, so the portfolio is more relatively resilient as Singapore assets are the valuations held stable over COVID, so they're more stable, more resilient as compared to a lot of overseas assets which saw cap rate expansion. So the MPI was up slightly this quarter. And their on cost of debt, they saw some improvement in their cost of debt. So it was 3.6% previous quarter. So now it's at 3.4%. And going forward, the guidance is also at around 3.4%. Yeah, so their portfolio occupancy is at 96.4%. And the rental reversions for them, they saw some 10.4% positive rent reversion for retail. So to 11.2% for downtown malls and 9.5% for suburban malls. And their office saw a lower 5.4% positive rent reversion. So they did mention that they still see some strong tenant demand for space as well. And the demand is mainly coming from overseas retailers and new concepts. And there is a limited incoming supply for retail space as well. So all this will help with the positive rent reversions, and occupancy cost is also trading at around pre-COVID levels for them at 17.4%. So going forward, slightly that positive rent reversion will slow to about mid-single digit from the high double digit or from like 10.4% that we saw in the first quarter. And there are some plans for an upcoming AI at Tampines Mall, so that will be in the fourth quarter for them. Yeah, and for the office portfolio, there is potential for single digit positive rent reversion. So that's mainly because their portfolio, their passing rents are slightly higher as compared to Keppel REIT. So the difference in compared to market is lesser. So the rent reversions are likely to be lower as well as compared to Keppel REIT. And yeah, like I mentioned also, the supply limitations, basically only Keppel South Central with TOP, and there's still a continued trend for flight to quality. So all that will help with the positive, likely low to mid-single digit positive rent reversions for office space for them. Yep. Next slide, please. Yeah, so for Impact, they released their FY24 results, their full year results. Yeah, so for them, their Singapore portfolio, especially VivoCity, was very strong, very resilient. There's some weakness in the overseas assets, especially in Hong Kong, China, and Japan. South Korea also was quite strong. So for their MPI performance, it was lower due to the divestment of Maple Street Anson and lower contributions from the overseas assets as well as Forex. Yeah, but they did have some finance cost savings after repayment of debt with the divestment proceeds of Maple Street Anson. Yeah, so they did have some divestment gains from Maple Street Anson as well, but they are not going to dispute that. So they're going to reinvest in the portfolio and lower debt as well. Yeah, so the portfolio occupancy is at 90%. Singapore remains relatively much stronger than the overseas assets. So the weakness is mainly in China, Japan, and Hong Kong. Yeah, portfolio valuations wise, Singapore's portfolio valuation, it rose by 660 million. So VivoCity drove almost 500 million of gains. So that is mainly from better operations. A slight proportion of that portfolio gain was due to a 10% cap basis point, or a 10 basis point cap rate compression, as well as some AI works that were done in VivoCity, but mainly is due to better operations that the portfolio valuations grew by 500 million or 14.8%, which is very significant. And there are some weaknesses in overseas assets which saw some negative valuations, and as a result, the whole portfolio was up 225 million. Yeah, but just to recall that over the last 2 quarters, they already booked in some valuation losses for the Japan Makuhari assets. So as a result, the valuation loss for Japan was much lower because they've already booked that in the last few quarters. Yeah, so the rental reversions, 3.6%. So VivoCity drove the rental reversions at 60.8%. The overseas assets also all saw single-digit negative reversions except for South Korea. So we think going forward, as the market for Hong Kong, China, and the Macquarie region, especially Japan, is still weak, and there are some potential vacancies, or rather, one of the Fujitsu, they're going to vacate the Macquarie asset in 2026. So vacancy will likely rise as well. So despite all that, or rather because of all that, and the weakness in the markets, we do expect rental reversions to be negative for those three assets, rather those three countries going forward as well. Yeah, and for the outlook, or rather there is some weakness that is seen from the shipping and transport sector. So these two sectors were also hit during Donald Trump's first presidency. So it is coming back, this weakness. And office tenants, like I mentioned during the Keppel REIT slides, they are signing shorter leases, 3 years, due to the uncertain economic environment as well. And yeah, for them, cost of debt to remain mid 3%, and tenants are more cautious. Yeah, and basically for them, Singapore, VivoCity still remains strong, and still weak single-digit rent reversions for overseas assets. So for that portfolio, is mainly driven by the core assets which are in Singapore, and any potential recovery will need to come from the overseas assets, which accounts for 40% of that portfolio. Yeah, so that's all for me. I hand over time now to Mel. Thanks.
Yeah, thanks, Darren. So Suntec released the first quarter 25 updates last week. Next slide, please. So results were in line with our expectation, and our first quarter 25 DPU reverses downward trend, rising by 3.4% year-on-year. And Suntec is likely to retain its managed investment trust status following the reduction of Golden 10s and Selling 10s over ownership to below 10% each. And this enables Australia's effective tax rate to revert from 45% to 10 to 15%, like the normal range. However, this is still pending regulatory confirmation. And Suntec has already set a provision for effective tax rate of 45% for its Australia operation in first quarter 25. And we anticipate a negative DPU impact of around 3.5% if Suntec lost the MIT status. And now something positive about Suntec is the rental reversion in Singapore remain resilient, with office and retail segment achieving 8% and 10.3% respectively. Renewal was still the main factor driving the leasing activity, as occupiers still remain cautious on the expansionary plans. And Suntec also didn't observe any downsizing or early terminations, with tenants still adopting the wait-and-see approach. And demand in CBD continues to be healthy, supported by financial sector players such as the hedge fund and also the asset management company. Revenue for Suntec Convention Center was the bright spot. It rose by 20% year-on-year in first quarter 25. And NPI also surged by 176%. And this is driven by higher proportion of the high yield events and also lower utility cost. And there's no signs of the event organizers delaying or scaling down their event, but we do anticipate the strong momentum to moderate over the remainder of FY25. And for negatives, the incentives in Melbourne is expected to remain high at around 40 to 45%, as negative net absorption in the office market is still persist. So we do expect occupancy rate to remain flattish for both Southgate Complex and also 55 Curry Street in 2025. And for outlook, Suntec is scheduled to refinance its 200 million perpetual, which is maturing in October 25. The management is still evaluating the trade-off between a higher borrowing cost while the perpetual issuance, which is estimated to be at around 4.5%, or to increase its gearing by issuing conventional debt with lower costs at around 3.5%. So we do expect the overall cost of borrowing to inch up slightly to around 4%, and currently is around 3.96%. And following the recent share price performance, we maintain our FY25 forecast, but upgrade from accumulate to buy. Yeah, our DDM target price remain unchanged at 1.33 and dividend yield of 5.3%. Next slide, please. Yeah, so OUE released the first quarter result last week, and the results are in line with our forecast. Something positive is occupancy rate for office and retail both increased by around like 1.7 percentage point and 1.3 percentage point quarter on quarter. And retail rental reversion moderated from mid-teens to 4.9%. And this is mainly because majority of the renewals was done at the higher floor at Mandarin Gallery, which yield lower rents. And the rental reversion for office was 9.9%, despite the cautious expansionary demand. And this was mainly attributing to the below market rate passing rent. And we do expect rental reversion for office to remain at the mid-single digit for FY25, supported by the very tight CBD supply, new CBD supply, given that Keppel South Central is the only completion in 2025. And rental reversion for retail is expected to be supported by the East overseas consumption leakage, since the market is anticipating weakening of SGD alongside continuous recovery of international visitors. As a result, we project a retail rental reversion of mid to high single digit in 2025. And cost of debt also declined by 0.5 percentage point quarter on quarter to 4.2%. We believe the upside of DPU is likely to come from saving in financing cost. In first quarter, financing cost decreased by 11% year on year. And for negatives, due to the high base in March 24 and also absence of catalysts such as Taylor Swift in first quarter 25, RevPAR for Hilton decreased by 19% year on year. And this is mainly driven by decreasing occupancy. ADR only decreased by a few dollars and is still holding up well. And for Crown Plaza, it continues to support its, the overall portfolio performance. RevPAR increased by 8.9% year on year, as more Chinese tourism is staying nearby Jewel. And overall, we expect hospitality revenue to decline by around 10.5% year on year on a full year basis. And for outlook, OUE REIT is actively perpetuating its 313 million divestment proceeds of Lippo Plaza back to Singapore and target to complete by third quarter 25. Assuming the entire amount will be used to pay down debt, gearing will decline to around 37%. Currently is 40-ish%. So we do maintain a buy with unchanged TP of $0.4 and is trading at a forward dividend yield of 7.1%. Next slide, please. Yeah, we have a Phillip on the ground for Keppel Ltd China Trust. Next slide, please. So jumping straight to its operating metrics, retail rental reversion was at around positive 0.5%, and this is mainly due to its supermarket AEI. But excluding the AEI effect, rental reversion will be negative 1%. And business park revenue down by 9.6% year on year, mainly due to lower occupancy at Hangzhou and also Alexander Innovation Tower. However, Sale City has already secured the new tenant, and occupancy is expected to recover from second quarter 25 onwards. And management also guided a positive rental reversion as they are directly signing the lease with the tenant. And retail sales was supported by consumption voucher from the central government, and the policy was actually varies by cities. For example, Shanghai issued digital voucher for dining, tourism, and also movies. And the voucher typically carries a 30% discount and is up to 1,000 per person per round. And they can even spend a Michelin restaurant in Shanghai. And there's also a 81 billion consumption good trade-in scheme in 2025. with subsidies of around 15 to 20% to trading for the older appliances, such as microwaves or smartphones. And there's also up to 30% discount for cities such as Shanghai and Beijing for appliances like TV or laptops. Yeah, so there's a screenshot on the right corner. As a result, IT sales was up around 23% due to the program, and Sales City is expecting more to come in the remaining 2025. And for outlook, the overall comment for Sales City is pretty negative. Rental reversion is still expected to be negative, even though the magnitude of the negative rental reversion will ease. And this is because a majority of the list is already being marked to market, and the management is taking an early renewal of some of the lists. So in second half 25, there will be very few renewals. A majority of the large industrial tenant expiring in 2025 has already committed to renew. And so far, they observe limited direct impact from tariff. And if there is any impact, the most like impacted cities would be like in South China, since like logistic demand there is more reliant on export activities. And it is still like early to determine whether businesses are downsizing in response of the uncertainty. But so far, they haven't seen any early termination or downsizing from tenants. And Chengdu Logistic Park is still in the middle of backfilling and expected to reach occupancy at around high 80s in next quarter, and currently is around 73%. And our Sales City is expecting 10 to 20 million revenue to turn offline for like around 6 to 9 months. And this is due to the 3 supermarket AEI at its retail sector. Yeah, so currently they are trading at dividend yield of 8.3% and price to NAV of 0.68 times. That's all for me. I'll hand over to Ding for technical pause. Thank you.
Thanks, Mel. Morning everyone. I'll move on to the technicals. Next slide, please. So first up, talking about looking at the S&P 500, there was a breakout above the 5,460 resistance, which the price tested 3 times. And then there was a breakout on Thursday. So I think this week we're likely to see some further rebound ahead. So first up will be to actually retest this or the orange line in the chart, which was a previous trendline support. Then that's quite close to about 5,640 as well, which is the red line, the 50-day moving average, as well as the 61.8% Fibonacci retracement level. We take the all-time highs as well as the swing low from around 4,835 this year. Yeah, so in general, resistance is likely to be around 5,585 to 5,700, and support at 5,350 to 5,460. Next slide. Yeah, so this one, this chart is looking at the gold to S&P 500 ratio. So the higher it is, it shows that investors are more risk off. And we saw there was actually a very there was a surge recently reaching above 0.6, a level last seen during the COVID 2020 times. And when we look at the 5-day rate of change, which measures the rate of change for one trading week, it also hit above a significant level above 10, which is the last time it hit above that was back in 2020. Yeah. Next slide, please. Yeah. So looking at what does this mean in terms of forward short-term for S&P 500 returns. Yeah, so for the past 10 occurrences in the 1 week following such a signal, it's quite positive for the S&P 500 to do a bit of a rebound. So on average, it's about 1.9% gains 80% of the time. However, when the time frame lengthens, when we reach 2 weeks as well as 1 month, it kind of turns back towards the negative. On 2 weeks, it's about negative 1.1% on average, and 1 month returns about negative 2.5% on average. Yeah. Next slide. Then as for gold, what does it mean for gold? I think even though we see this surge into gold price recently, right? Following such a the high rate of change instances for the past 10 occurrences, gold tends to hold up pretty well. So on average, 1 week returns about 0.4%, and when you stretch it to 2 weeks, about 0.2%, and 1 month is about close to flat. Yeah, in terms of the number of times it being positive is around 50% of the time as well. So it still remains the goal still remains quite resilient during such signals. Yeah, so that's the takeaway. I think even though gold is outperforming S&P 500 for the time being, I think the outperformance can be sustained, even though it's quite high right now based on the historical occurrences. Next slide. Yeah, so also this table is actually looking at some of the bear market data for S&P 500 for the past 10 occurrences. So on average, when you look at for bear market, the typical drawdown from peak to trough of 36%. And then during a bear market, what's notable is that we tend to see a large bear market rallies. So that's usually can be high 10%. So on average, about 16.4%, sometimes even stretching over 20 over percent. In terms of the overall bear market duration, on average, about 409 days. So that's just slightly over a year. So currently, what we are seeing right now in the market is also very large. There's also a very large relief rally since the short-term bottom around 4,830. So currently, it's about the rise is about 14.3%. So that's that fits in quite well with this kind of bear market rallies we see in the past as well. Yeah, so that's all from me. I'll hand over time to Paul to give an update on Keppel. Thanks.
Yeah, thanks, Dean. Sorry, let me try to. Oh yeah, thanks, Dean. So, Keppel came out with their first quarter update. The key highlight for us was that the earnings growth for Keppel is more visible now. Next slide. So in their first quarter update, they usually don't give any numbers. They only give this number, net profit up 25%. It's obviously a good number, but I mean, the only caution we have is that they sometimes will include valuation gains into this number. So they didn't disclose, so we can't really tell how much is operational, how much is valuation gains. But we think most of it comes from disposal of real estate, especially Vietnam and China. So that's the first positive, and also the comment on the results. The second positive is the better earnings visibility. I think most of the divisions are executing their new projects that should be complete this year until 2026. We'll elaborate more in the outlook part. The negative was the mobile. So M1 subscribers continue to slide, so they are sliding about 7%. They didn't give much details. They said the EBITDA was still strong, but it comes mainly from the enterprise business. But ironically, a weak M1 could be a good news for Keppel. I mean, it will give them more impetus for them to sell M1 to most likely StarHub. In terms of our outlook, no change in our numbers, no change in our forecast. The highlight for us, like I mentioned, is the improved visibility of operating earnings growth. So first one would be the Keppel South Central. So it was completed, like what Darren mentioned, in February, and it's already 50. They mentioned around 50% of the space and retail is already being committed. So this would contribute to revenue this year, or earnings. Then the second part is the infrastructure business. So just to dial back, now Keppel has three parts. There's the property, then there's infrastructure, which is mainly the power business. So that will get a big boost once the Keppel Sakra plant turns on in the first half. And most of the capacity has already been fully contracted, and the gas has also been hedged, they mentioned. The third part of Keppel business is connectivity, which is like the data centers, and the new growth area will be from their Bifrost subsea cables, which will be completed in the second half of this year, and that will also give rental and maintenance fees. So just be a bit more patient. The operating earnings should start to improve from second half onwards. And of course, you will also get the benefit of the disposal gains, or either M1 or even their REIT business, the REITco, the 4 billion at REITco, which no change in their 10 billion divestment assets that they plan to divest by 2028. I still my mind, but yeah, I need that, no change in that target. Next slide. I'll move on to our usual weekly. Next slide. So not much news from the US and China. A lot from Singapore. So for Singapore, they had a lot of the visitor arrivals numbers came. The headline numbers are pretty bad. Down 11%. China arrivals down 24%. But because there was the Taylor Swift, if you recall, last year, early March. So very hard to strip that out, but at least for the first quarter, it's still flat. But the underlying trend for tourist arrivals is still quite slow, or at least flattish for Singapore. The next big news is the property transaction. So that is still very strong. So first quarter transactions in terms of new home sales, private home sales or private resale is still very strong, almost 72%. And this is after fourth quarter, 72%. So the positive momentum will be more positive for real estate agents like Apex Realty or Propnex. And the health of the market is still strong because the inventory breakdown to 2.1 years. I will explain later. Industrial production for Singapore still, that means manufacturing activity is still generally healthy. First quarter about 4%, but again, there's a lot of front loading, so you never not clear what's the underlying trend. Next slide. So in terms of our tactical views, which we normally send out in P3 and also in our morning note, if we think the rebound is sustainable, because the results, especially from the US, has been generally been positive, and there hasn't been any dire profit warnings. So that's the first reason. The second reason is that the pull in demand is probably boosting the results for the first quarter. And the third reason is, of course, Trump is also reeling some of this aggressive posturing. And like what Zane mentioned, any rebound can be quite strong. I mean, like if you average out 16%, that's probably that is probably like 1 year return for most stock markets, even for Singapore. If you can get a 16% rebound, so this rebound we think can sustain at least for the very near term. But after that, I think as we approach the 8 July 90-day deadline for reciprocal, then I think it gets a bit more worrying, because so far most of the trade discussions, the commentary has been not much information from the US or communications. The second thing to worry about the trade war is what is China's game plan. I mean, we obviously no idea, but we're just making a guess here that if we assume they are doing this war of attrition, whereby if China wants to see economic and inflation pain in the US before they start to negotiate, then I think we should. It will be a long time. It will be some months before we get any relief on trade war with China. So that would be the negative. Some of the meetings I attended, I did attend the CDL AGM. Apart from all the headlines there, but just focusing on the share price itself. I mean, the management did say that they are cognizant that they need to lower gearing, but the problem is that they mention no plans. Not like if you do a Keppel or you do a Singtel, they have plans to at least monetize a general roadmap to monetize, but of course nothing coming up from CDL. No share buybacks I just checked. No share buybacks. No insider buying. I mean, the independent directors combined only own 140,000 shares, so not much skin in the game. And we worry that this stock will become like the bait, the bait of the Venus flytrap, to try to attract you with their 1757 share price, and then you get stuck there. Partly in jest, I mean, we are saying this. In terms of the REITs, I think listening to some, I mean, the one that stuck out for me was Mapletree Logistics. So they have like 15% exposure to China, when China is really problematic. So China's problem is that firstly, the rental reversions is still down 9 to 10%. I think they mentioned the office in Beijing, the vacancy, that means the empty buildings is like 20 to 25% vacancy. And the second problem is that most of the leases now is 1 year. So you can just do most leases are 3 years in office in Singapore. So any weakness, it will take 3 years to kind of filter out. But if you assume like 9-10% every year, after 3 years, you're talking about 30% decline in rents. So any REIT with China industrial exposure is going to be problematic. The other problem for Mapletree Logistics is that Singapore is actually very healthy for most REITs in Singapore. I think like Mapletree, Vivo City was up almost 16%, 500 million jump. But industrial is a bit more of an issue. I mean, based on listening to all of the REITs, I think for Singapore industrial, of course, you have this worry of the trade. Near term will be positive for industrial because there is a bit of there's everyone cancelling orders, so there's a lot of inventory stuck in the warehouse. So near term positive, but longer term, if this trade war persists, there could be issue. The second thing is a lot of part of Mapletree Logistics industrial properties are short term, so less than 20 years. So once you hit below 20, you're going to get the time decay, the lease decay, whereby the value is going to cut your valuations. Because can't be like 10 years left, they're going to cut even more aggressive. So that's the one issue. The positive from all the corporates that all the data points is still going to be the residential. So like PropNext is still going to benefit like 2 quarters or 70% jump in private volume transactions. In terms of the events, this week is going to be a lot on the Max 7 results, I think, all for you to see. And of course, there'll be the payroll numbers. Don't expect any impact yet from the tariffs because it's still early days. These are some of the events that we're having. CNMC Gold Mine on the 15th. Okay. Next slide. This is just to show the visitor arrivals after the big spike. I think they're starting to move sideways. Only China is growing, but I think most countries like ASEAN, Europe, they're all starting to move sideways and starting to dip a little bit. And because when RevPAR is also starting to move sideways, which is basically hotel revenue. Next slide. If you move on the property transactions, so you can see that the new home sales is there's a big spike, the blue line at the bottom. Red line is still rising, so total transactions is so that's what we're playing. Like we mentioned before, we're trying to buy this big spike in volumes for the real estate. Inventory for developers are actually quite healthy. After the problem, the red line is inventory to sales. So it means how many years you take to sell the inventory out there, either launch or not launch. But right now it's back down to 2.1 because of the big volume jump. So the inventory, so the property market in general is quite healthy in terms of the inventory available to be launched and sold. Next slide. Yeah, I think that's it for me. Thanks, Evan. You can move on to Q&A.
Yeah, maybe I can take some of the Q&A first. I think I got two for me. First one is iFast. Yeah, so they released their results, but we haven't attended their briefing yet. It will be in about 2 hours' time. Yeah, so just based on what I could see, the question, sorry, was how was iFast results? Why drop so much? Yeah, the results were pretty good. I mean, if you look at the top line, how they did for first quarter, it was quite okay. But I think the main highlight, okay, because the AUM went up, their fee income also went up, but their banking also did turn around. I think now they're a profit of 1 million for first quarter, so that's positive. But however, I think the reason why the results, why the share price actually didn't perform as well, even though they did have quite a positive set of results, was that they lowered their Hong Kong targets, their e-pension business. So currently, their e-pension business, if you look at the profit before tax line, it makes up about, at least as of first quarter 2025, is more than 50% of their profit before tax over the total. So it's quite a huge chunk. And when management does lower the guidance, right? So they lowered their 2025 guidance by about 24%. So it was previously about 500 million Hong Kong dollars. Now it's down to 380 million. So we have seen it really come in the first quarter where there was actually a decline in the profit PBT. And they are saying that this is really meant coming from the higher expenses where they try to build up more of the platform, and also for the e-pension business. So that's why we saw this decline in the profit. So we will see that, I think, for the rest of the year, and that's why they have lowered it by such a huge amount. And if this is something that makes up such a huge amount of their profits and they lowered the guidance, we could be seeing slightly lowered growth in terms of their total profits. I don't think the ramp up in their global banking business can offset this decline, which we will probably see coming in for the rest of the year. So they gave this decline and also provided some 2026 targets where they said that they are looking at double-digit year-on-year growth. Yeah, so I think that's the main reason why we saw the share price actually drop quite a bit even though they released a positive set of results for the first quarter. I think one more on OCBC. Yeah, so asking specifically for OCBC, please update on the target price of $17 plus. So it's currently $17.10 for OCBC in view of the present economic uncertainty. Yeah, I think I'll just speak, not just for OCBC, but maybe for all the banks as well. We have maintained our target price as of the last we updated was on 17 April. Right, so DBS is $43.90, OCBC is $17.10, and UOB is $39.80. And why we believe that the banks will be quite stable is because we believe that they can maintain their net interest margins as well as their net interest income, mainly from the steepening yield curve as well as the higher CASA levels. So that's one of the positive figures that we have seen coming in, is that the CASA or current account savings accounts, and this is essentially almost as good as free funding for the banks. This is like your one account or your multiplier account where you put it in, and the base interest is so low, it's like 0.05%, if I'm not wrong. Yeah, and that's it's like free funding costs for the banks. So we have seen that increase, and we expected it also mainly because the fixed deposits that a lot of people put in their money maybe a year or two ago, right, when it was like 4+%, high 3-4%, it's now starting to roll off, right, that 1 year. So they don't really want to put it back into another fixed deposit because interest rates now are like 2+%. So they either put it back into investments or they put it into CASA, right? So we are seeing this split, and that's why the CASA levels are increasing. And we have seen the CASA levels also actually increase to 19%, sorry, in February. And that was, I think, the first time that it went over the 18+% amount. And I think it will continue to increase, as more of these fixed deposits mature and get shifted back to the CASA. So this will be beneficial for their net interest margins because now their cost of funds is lower. They also have, minimal exposure, to the most affected sectors in this trade war and this present economic uncertainty. That is being the manufacturing segment as well as the ASEAN sector. So I think they have only around 15% kind of exposure. So we believe that they will still be able to grow loans growth. But we would see a decline in loans. I think there are at least a decline in the growth. So they're guiding for mid-single digit to high single digit. I think we will see it coming in slightly below that mid-single digit figure for loans growth in 2025. But it's still, of course, improvement from the previous year where we saw only like low single digit kind of loans growth. And last but not least, the dividend yields for the banks are also extremely attractive. It's hovering around 7 odd percent now, right? As we believe that they have enough capital set aside already to give out what they have promised, right? And they will continue to give this out, at least for the next 1 or 2 more years, which they said that they will. Right, and I think the only caveat and I guess the only risk could be if earnings decline, then both UOB and OCBC, we could see a slightly lower dividend because theirs is not pegged to the dollar amount, but it's pegged to earnings. So they will usually give 50% base dividend payout ratio, and then their special dividends is extra 10% dividend payout ratio. So it's really based on how well they do. But for DBS, it's quite safe, which I think is also a possible reason why they are sort of faring better than the other two, because they give an actual dollar amount as to how much they will give. So it's easier for investors to say, okay, if I put it in, this is how much dividends I will get, right? The actual amount. I think it's around, for FY25, we expect $3 for DBS, right? So it's easier to I guess, forecast how much dividends you'll be getting if you put it with DBS. Whereas for the other two, it's really dependent on their earnings. Yeah, so I think that's, yeah, and one more thing also is, with all the capital returns, they have started to do share buybacks, right? So they have not held back from doing the share buybacks. I think all 3 banks have done share buybacks. So it's a good positive for any investor, is that if they are, they are continuing to do with their share buybacks. So it also shows confidence that they will also continue to do with the dividends, the extra dividend and special dividends payout, which is why we believe that this will definitely continue for at least how long they have, all the banks have each said that they will do it for. Yeah, okay. I think suddenly quite a few questions came in for me. In terms of valuation, are the Singapore banks still over undervalued? I think it's for now, it has gone down a bit, right? A lot of people look at the price to book ratio, the PB ratio, and it's a good thing to look at, but you must look at it together with another factor, which is the ROE. So the bank's ROE has been going up in tandem with the price to book. And now if you look at the share price, it has gone down, right? So the price to book will have dipped slightly, but we still expect ROE to continue climbing. And a higher ROE will of course improve the valuations for the banks. Okay, let me just answer this one first. Any ideas if OCBC or UOB will be moving to giving dividends quarterly instead of half yearly? UOB specifically said that they won't do it, right? They said it during one of the analyst briefings, I think last quarter or like 2 quarters ago. Yeah, they said they won't do it. They said no reason to do it. So I highly doubt that OCBC will also shift to a quarterly dividend payout instead of half yearly. Okay, someone asked also about the dividend payout. Yes, if it includes the special dividends, yeah, it includes the special dividends. Yeah, what's my view on the banks 2 to 4 years from now? I think the Singapore banks will remain very strong. They remain the pillar in Singapore's, especially in the STI, right? If you look, it's almost more than half of it is the banks. They will continue to grow. I think a lot of them have tried to grow inorganically, right? If you look at DBS and UOB, they are expanding out of Singapore into Asia and ASEAN, right? So they will probably set their sights to see growth more in those areas, right? Because Singapore is so saturated, at least for banking wise. So I think they will look into other geographies where they can continue to grow, and of course they will also be looking at more into fee income instead of just the net interest income or net interest margins to grow, like loans growth, right? So they're looking into fee income, non-interest income, kind of to continue growing their bottom line. Yeah, even OCBC also, they may not have done a lot of acquisitions, but at least they did acquire the Indonesian bank. They also did try to, at least, they're still trying to acquire GE, right? Which they said that it will give them a more holistic approach when they look at the overall OCBC group. Yeah, so they are also doing some things. Yeah, I think that's all for me. I'll hand it over to the rest of my colleagues. Thanks.
Thanks,
Alright.
Ken.
Yeah, you go first, you go
Oh,
first.
okay, thanks. Yeah, I'll take on some questions. First one is please advise on AEM after Intel results. Yeah. I think just for context, for those who don't know, AEM's key customer is Intel. Yeah, so as presented just now, Intel guiding down their CapEx and OpEx. I think that will directly benefit AEM. Directly impact AEM negatively because Intel will be spending less on their OpEx and CapEx. Yeah, so there will be a direct impact. However, I do think that AEM has been trying to diversify out of Intel, and right now generally in the industry, foundry and equipment makers have been experiencing an uptick in revenue growth. So I do believe that the general trend now is in the industry is quite positive, and that may benefit AEM as well if they are able to score contracts with other players outside of Intel. Yeah. I think there's also one question asking about comments on Aztec Global, especially its NAV. Yeah, so right now Aztec Global, their NAV is 44 cents. If you look at the current share price, is quite close to the NAV per share of 44 cents. However, our view on Aztec Global is really quite negative because Aztec Global, in their most recent results itself, their revenue is down almost 60% year on year, and their net profits is down like more than 90% year on year. So and there are very, very bad signs, very worrying signs because recently they stopped disclosing their order book because they have trouble. I believe they have trouble securing new orders. That's why they stopped disclosing their order book. That is one thing. And second thing is when we ask for whether there's any analyst briefing, they also stop the analyst briefing and stop contacting analysts. Yeah, so So I think that's the troubling signs of Aztec Global. Yeah. So I mean, in their net asset value, even though they have a lot of cash, we don't think is very salvageable because the revenue and net profits is down so much. I think this trend will carry on for the next few quarters. Yeah. Yeah, I think I'll hand over the time to my other colleagues now. Thanks.
Yes, thank you, Ben. I'll just take the Alphabet question. So is Alphabet another resilient stock like Netflix following its result? I would say yes, but it's not resilient in the same way as Netflix. So for Netflix, not only is it not impacted, it might actually work in its favor because instead of going out, people might stay in home. So actually more people might subscribe. And they're also continuing to increase their prices. So it might work in their favor. But for Alphabet, definitely it's going to be adversely affected. But I would say they're considered more resilient compared to other companies due to several reasons. First, their business model, because most of their revenue come from digital advertising, which is not really directly exposed to tariffs. They do get impacted by Chinese retailers like Temu and Shein. They're pulling back in their marketing because obviously it doesn't really make sense for them to sell to US anymore. But their advertisement revenue stream is very diversified globally. So that is just like a very, very small fraction. Doesn't really affect them much. In terms of cloud services, it's still doing really good. They're continuing investing in their AI CapEx, and demand is still there. So it's still about them worrying they're not investing enough instead of they worrying that they over invested. Their recent earnings are pretty strong, solid advertisement revenue. They have growing AI adoption and very stable cloud performance. And I guess in times of uncertainty, investors, they always tend to shift towards quality tech stocks, which have a strong balance sheet and pricing power. And Alphabet kind of fit perfectly in that. So yes, it's considered more resilient compared to other stocks. I hope that answers your question. I'll pass my time to my other colleagues.
Yeah, thanks, Helena. Let me run through some of the questions. Any comment on Mapletree Logistic results? Yeah, so Paul gave some comments earlier. I'll just add on to a little bit of them. So for MLT, basically 15% of their tenants are export market driven, and specifically those that are those who serve the US basically are low single digit percent. So they are not really that affected by the US tariffs because of simply the fact that they serve a low single digit percentage of their portfolio is they serve the US. Yeah, and for China, about 17% of the leases are now 1-year lease. Like Paul mentioned also, there is a trend that leases are now being signed shorter. So right now, 17% of it is 1 year. So if you think about it, if every year when they renew the lease is negative, like high single digit, so basically over 30 years, you are seeing over upwards of 20% negative reversion. So it is some weakness there. But for China, the silver lining is this is not the first time, as since the trade war in the Trump 1.0, basically China have really diversified. So 90% of their Chinese market, they serve the local market or serve domestically. So you're not really impacted by the US. Yeah, and basically for logistic players, a lot of them are still having a wait and see approach as well before making any decisions. Yeah, and also, yeah, portfolio valuation wise, Paul mentioned also Singapore is hit by land lease decay. So as a result, there is some valuation decline for Singapore as well. Yeah, but overall portfolio valuation for them, it declined a little bit. Yeah, so those are some of the highlights for Mapletree results. But yeah, there's a question also on whether do you see the bottom? Let me find that question that is yeah, is there any turnaround hope for MLT and what would be the timeline? How much price downside likely? Yeah, so for me personally, I think it's still there are a lot of uncertainties regarding this trade war thing. So not sure how it will play out. But for me, I think the share price has really corrected. I think it might have overreacted as MLT usually trades about 1 to 1.1 times price to book. Now it's at 0.85 times price to book. So I think a lot of the negatives have already been priced in. But I can't really call a bottom. But personally, I would think a lot of the negatives have been priced in already for MLT. So yeah, if you are a long-term investor, yeah, might be opportune time as it's just on the fact that it's really been sold down and it's now trading at 0.8 times. So that is significantly below its average of about 1 to 1.1 times price to book. So in my opinion, I think it has been already priced in the negatives. Yeah, I hope that answers the MLT questions. There are quite a few of that. What is the outlook on S-REITs, especially in the current tariff war? Yeah, so the outlook for S-REITs for us, and there's no first order impact, so it's mostly a second, third order impact, like from a slower economy, consumer sentiment slows as a result. For perhaps the retail spending, for instance, will slow, travel demand may slow. The expansion plans for corporates also may slow. So all this is more of a second order effect. It's not really a first order effect. So it might take some time to trickle down. Yeah, but we are more for us, we still favor the REITs because first of all, they're trading at a very low price to NAV as compared to historical levels, about 0.866 times or even lower from the recent share price performance. So that is compared to about a 1 times price to book average that REITs usually trading historically. So based on that also, we think it might be an opportune time, and especially since with interest rates coming down, there is more potential. Like we've really seen in a lot of the REITs, like about half of them already having interest cost savings in the first quarter of this year. So going forward, it's likely they'll start to have more interest cost savings as interest rates continue to come down. So that will have improved the DPU, absolute DPU performance, and as a result, the dividend yield will also improve. So those are some of the plus. Yeah. So for us, we think S-REITs are still positive. Yeah. As compared to a lot of other equities, like on a relative basis, especially. Yeah, but specifically on the impact of tariffs is more of a second and third order impact rather than immediately impacted by the tariffs. Please update our schedule date on Paragon REIT. Yeah, so if you're not aware, the unit holders of Paragon REIT, they have already approved the scheme. So basically, Paragon REIT will is expected to be delisted in the coming months. But for the date specifically, the expected last day of trading of Paragon REIT units is for now is expected to be at or around 14 May. So that is in 2 weeks' time. Yeah, so if you want to trade your shares, you have about two weeks before the share gets halted, and yeah, as a result, you'll be delisted soon after. Yeah, so the date if you want to trade is before 14th May. Yeah, please comment on CSCT results. Yeah, so for CSCT results, I went through a flip on the ground. Any impact from tariffs? Yeah, like I mentioned, it's more of a second order impact, like a slower consumer spending and a bit of cautious sentiment from the office tenants where they are holding back on their expansion plans. So those are more of a second order impact for the tariffs. Pertaining to CICD, what's the net effect of the divestment of 21 K and the acquisition of 50% unaffected to the DPU payout for FY25 on a year-on-year basis? Yeah, so for that, we don't cover CICD, so I don't have any forecasts for 2025 DPU, but the acquisition for Ion Orchard was accretive. Yeah, so we can expect a low single-digit accretion on a year-on-year basis for Ion Orchard. And on top of that, currently Ion Orchard is also performing better than originally underwritten. So yeah, slightly we can expect slightly higher DPU accretion for that. MPAC, what is occupancy like for Japan, Korea, and China assets? What is the trend? Yeah, so for Festival Walk, the occupancy is at 96.8%, so it dips slightly over the past few quarters. From 1 year ago, it was 99.7, so it dipped by about 3 percentage points. For China also, it's at 86.1%, the occupancy for Japan Asia. So the weakness there, rather the focus now is to at least have some tenants there instead of just having it vacant. So a low single digit rental reversion is much better than, it's really no issue as compared to the property being vacant. Yeah. Yeah, and for Japan right now it's 79%. So 1 year ago it was at 97%. So going forward, one of the tenants also at the Makurai buildings will vacate in 2026. So the occupancy will likely to dip further for Japan. Yeah, and also negative reversions likely to remain for that as well. Yeah, Korea, the occupancy is back to 99.9%. And they also had some strong reversions for this quarter at 29% or 26%. Yeah, so for Korea, it's a relatively strong market for impact. Yeah, what is the rental reversion trend like for impact also? That's a follow-up question. Yeah, so Japan is likely to be weak. So negative high single digit, possibly even negative high double digit for Japan, especially since they have to lease up so much space from the vacate upcoming. Korea right now, the negative, or rather the positive rent reversion was 26%. So that is a strong number. And China is also likely to remain at around negative high single digit going forward as well. So we've seen similar levels of high single digit negative reversions for China and Japan and Hong Kong as well. So this trend likely to remain in the current economic conditions. Since JB is also going to be very big in data center investments, will this negatively impact KDC or synergistically? Yeah, so for now it's still hard to say the impact, but generally for Singapore, data center is focuses more on inference work, while JB focus more on training. So as a result, it's not really an overlap on this. Yeah, so for now it's still hard to say whether it will be negatively impacted, but for Singapore, generally the market is still bound by very limited supply. And as we've seen from the high rental reversions that Keppel DC managed to generate from some of their core co-location Singapore renewals, so the demand is basically still there. Yeah, so yeah, I would say it's more synergistic for now, as Singapore focuses more on cloud and inference work, while JB focuses on training. So the focus is different. Yeah, I think I'll hand over to my colleagues for now. Yeah, thanks.
Thanks, Darren. I'll take the CLCT question. What's your view on CLCT C-rate and the expected impact on CLCT? Yeah, so there's only like 2 set will be injected in CLCR, which is the C-rate, and it's at like around 2.8 billion RMB. And the divestment gain will be injected into the C-REIT, and they have already secured the regulatory approval and pending some legal documentation. Yeah, and we believe it's a net positive for CLCT, given that they can tap into the local China capital market, as C-REIT is only investable for local institutional investor and retail investor. And also, given that CLCT in China is pretty well known as a very strong retail operator. Yeah, so the feedback would be very positive. And its peers are trading at dividend yield of around 4 to 5%. And they're also expecting slight premium to its book value. And there's also no specific tax incentives like what they have in Singapore, and is subject to a withholding tax of around 10%. Yeah, that's hope it answers your question. I'll hand over to Paul. Yeah, thank you.
Thanks, thanks, Miao. Let me try to answer some. What do you make of Yang Zhijiang's financial spin-off news? Apart from making apart from doing a lot of shouting and news and all that, I'm not sure if they. Okay, so Yang Zhijiang Financial wants to spin off their maritime assets. So I'm not sure if I don't know how this this spin-off maybe at the margin it can improve, since financial companies or Chinese financial companies or banks are trading at I'm not sure what's the latest. You know, they usually trade 0.5, 0.6 times book. So maybe that could help at the margin. But I'm not sure if investors are now rushing to go and buy some maritime assets in view of this current environment. It depends. I think tankers, I think it could be a bit better. But depending what are the maritime assets, sorry, I didn't really follow. But if it's container, of course, it's no way. I mean, with this current trade war. So I think it should be better, since right now, like I said, or anything related to the Chinese banks, so you probably can get a lower discount than being tagged a Chinese financial with 50% discount to book. So that could be one positive. CDL, AGM, what are the learning points for corporate governance? Okay, not for me to go and teach anyone corporate governance, but my own takeaway was, you know, you are independent director, you don't have much shares in the company, but you speak so loud. So I don't know how that works. The second thing is that to vote in, there were no laws broken. Okay, otherwise so the issue was the two directors coming in. There were no, I mean, if there were laws broken, the two directors wouldn't have come in. So although maybe they were not happy, you know, because maybe the chairman wasn't informed, but there were no laws broken. So that's the key point here. And you know, it's up to the shareholders. After that, you go to the AGM, and for the shareholders to vote whether you want these two new directors to come in. So I mean, to take it without putting any emotions into it, no laws were broken. So of course, maybe they were not happy the way the process was done. Maybe some directors had time or no time, but that's not the issue, right? The issue is whether any laws broken. So nothing was broken in that sense. What's the outlook for Comfort? I think for me, for Comfort, usually two parts of the business doing well, then the one is not doing well, and then it kind of flip-flops. So the three business is mainly, or maybe the two or 2.5. The taxi is a bit slower this time around because of competition in Singapore, and taxi in China a bit slow because they can't rent out so many. But the other parts of the business, sorry, let me move on to the bus. The bus is doing well, especially, so that's the second part of the business. The bus is doing well, especially in UK. And UK is also riding on stronger currency, 3% jump in the currency, and also lower interest rates because they made some acquisitions. So that is doing well. The only thing is rail. So the rail in Singapore is always problematic, and I think it's going to be easy for them to make any profits, because otherwise, you know, everyone's going to start complaining you make profits. So the rail, I think structurally is going to be an issue. So again, it's the usual. It's still going to be the bus that is going to carry. So we're still looking at the acquisition. So we're still looking at maybe low teens growth for Comfort. Yeah. So in general, that is the positive. For SBS Transit, nothing, no real change. I think they got hit badly because of the advertising that they lost, but I think they should recover. I think BRC Asia, I'll leave it to Yik Ban. Hypo, going forward, the lowering of economic forecast by government IMF affect the housing demand, which in turn it could affect sentiment. Buying property these days is so very heavy on sentiment. So I'm watching more the next upcoming launch. So March wasn't really a factor, and lower interest rates. So I still think it'll be positive. It may not jump that the 70% volume growth, but even a 10-20% growth in this current environment, I think is still a positive. Because if you look at some of the other key factors for Singapore, banks are still willing to lend. Employment is almost still full employment in Singapore. So it might shave off a bit of demand at the margin, but I don't think property buyers look at IMF data or it will look a bit, but I think it just hurts sentiment at the margin. I think the whole so long as HDB prices are still rising, the whole upgrading cycle, like a better word, is still intact. Government grants are still there, so I think it's still intact. I think my own view, maybe not as fast because people are a bit more concerned with the weakness right now, macro weakness. Okay. Okay, sorry. Quite a lot here. Any update on the outlook for CSE? Yeah. So for CSE, nothing much. So CSE Global is still going to be riding on the whole upgrading of the electrical grid in the US. But the problem for me, for CSE, again, this is my own view, for what it's worth, 5-cent view, is that you're buying CSE for exposure to the US. Because 60% of the revenue from US, I mean, really, do you want to buy a Singapore company to gain access to the US? I mean, not like there are no US companies to buy. I mean, that's my own view on the stock. Fundamentally, the company is still doing well, but for me, it's like, that's finding a tough sell to go and use this as a proxy to get into the US market by buying their data center and their upgrading of the grid exposure. I mean, like, is this really the best way to get exposure to that? Yeah. Not like there are no US stocks to buy. Yeah. Okay. Okay. Is Yang Zhejiang spin-off good or not? Okay, I think we have answered it. I think it's good at just to maybe narrow the valuations a bit. Okay. Sorry, there's a lot of questions. Apologies. Let me try to. Okay. Is it too late to add her position? I know there are two questions on ST Engineering. I still think it is. Because ST Engineering is not all defense. If this is a pure play defense, then definitely the sky's the limit, especially if in Europe. But no, Europe will probably buy a little bit more from them, but Europe wants to locally source also. And defense is roughly 1/3 of the business, or 40%. There's still other parts of the business, which is the aerospace. So that I'm a bit more wary, because they do work for Boeing, and they have facilities in China. So if Boeing in China not going to do anything with Boeing, then there are some negative parts to the trade war that is going to hurt them, because they have facilities in China too. So this trade war, they are not immune to this trade war. So that's my own view. So that's why I'm a bit more cautious, especially of the rally on the share price. That's okay. What would be the worst case on CDL if they keep not monetizing, no share buybacks, insider? How will it affect shareholders? I mean, it won't affect shareholders. I mean, the RNAV will just continue to rise, and then and they will probably eventually do something. I'm not saying CDL won't, but I'm just saying they didn't say anything during the AGM. They just said that they want to do something, but I also want to do a lot of things. Doesn't mean I'm going to do. I also want to go to the gym, right? I don't say I'm going to do it, right? But for me, it's more. They still want to do the REIT and all that, but there's no plans. They don't mention anything. So the worst case is just the RNAV will still grow. So and you have the you have the tailwind. I mean, there's still that huge discount. So everybody knows it's very cheap, and maybe that will placate some of the selling. It's just the time. No, you just have to be like a time investor. Just wait for a very long time for them to monetize something. So it's not like the business is deteriorating, the RNAV is collapsing. So you don't have that worry. It's just when are they going to materialize and narrow this? So you're just not sure, because they've not done it for so many years. What's the view on STE? The market seems, the market seems to disagree with me as normal. Yeah, so yeah. But for me, I still like Keppel Corp if you want to play some of these large market, because what I've observed is that the market seems to be very favorable if there's any good news. So Singtel, even though a little bit of good news, so the stock can rally. Of course, ST Engineering, very strong news. Semcon Industry. So I'm just waiting for Keppel. So all the large caps in Singapore, especially the government-linked companies, do have a very good response. So the market reaction to any news from the GLCs is actually very positive. So there's like a re-rating of all the Singapore GLCs. So I'm just waiting for Keppel. I mean, yeah, of course I'm biased because I got to buy, but that's my own view. Just to clarify on view on interest rates, what is likely to continue reducing with the inflation tariffs? Yeah, okay. So our own playbook, our own guess. This is our playbook on playing the REITs and also buying bonds. So we think you're only going to get the rate cut when you have the very weak economic news, because we think the Federal Reserve hands are tied. They can't do anything because if inflation keep on rising, they're going to cut rates. So we're just waiting for the bad economic data. So that's why in terms of timing wise, be it bonds or even REITs, the better time would be the later part of this year. Again, this is our playbook. Doesn't mean it will come to fruition, but this is our own view. I'm not holding any shares yet, making so much noise in the. Yeah. Again, this is just my own view. Don't quote me. What's the PE for the STI now within the one? Yeah, my last check, the STI is still within the one standard deviation, so it's still low. I think the STI valuation is probably 11 times PE. The average is about 14. So, but that's because the banks are trading usually at 10 times PE. Yeah. Okay. I think I will leave out I'll leave. Can you comment on the cash offer of Cinemas Land? Yeah. Actually, the one interesting thing is a lot of Indonesian companies are privatizing. I'm not sure how much is it to do because there's a new president. I do not know, but I no comment is fair and reasonable, and this stock really have no volume. So of course they will never get a fair and reasonable thing. I think it's yeah. So it looks attractive. I mean, because there's really no volume in this stock. That's why the better way was always to just buy the Bumi Serpong, which like 70% of their business all come from Bumi Serpong. Sorry, it's not very useful comment about me. Is QMM proposing second listing a positive development? I think it is, but the only unique thing about QM compared to the Singapore semiconductors is that there is no major dental chain in Malaysia. Whereas you bring a semiconductor company, you bring a Franken and then you go to Malaysia and you tell them, oh, I got this nice semiconductor. They tell you there's another 20 semiconductor companies I can buy. But if you bring QM 16 times PE and you say this is a unique dental chain that is growing, maybe they can get more traction with the fund managers there. My guess, I've no clue on this, but this is my own guess compared to what like Grand Venture all trying to bring their own thing and try to narrow the gap. I think the ability for fund managers to bite on that when they got semiconductor stocks on their own country, that one I think is a tougher challenge, my own view. Yeah. Okay, thanks. I think I'll pass on to the rest. Yeah. Thank you.
Okay, thanks. I'll move to the TA portion. So let me just share my screen. Okay, first I think I saw a question, about whether the GE will have the upcoming election will have an impact on the STI. I think I took a brief look at some of the historicals. So in terms of past 3 elections, I don't think there's gonna be an impact. So for example, you look at 2011, when there was a GRC loss to the opposition, the STI the next day went up 1.2%. Then in 2015, when the popular vote went back in favor of the ruling party, the STI was down 0.5%. And then the latest one, 2020, another GRC went to the opposition, STI was down 0.8%. So I think it's basically like a coin flip. I don't think there's going to be an impact in terms of Singapore's context for elections. Yeah, so I'll move on to the other questions. So first up is Singtel. So I think Singtel overall, the price action is still very strong. So after a breakout of 364, we're still seeing a bit of a price consolidation. Currently, we're still quite okay, around 372 to about 380, a bit of resistance. So I think it's still likely to hold the uptrend. Next levels to look at will probably around 386 as well as 392. Yeah, so I think the uptrend is still holding quite well. It could still continue the uptrend. For oil tech, I think recently the price action also is quite strong. So yeah, a bit of a consolidation, and then I think on Thursday there was a breakout on high volume over here, surge. So also going above the 122 resistance, currently retesting this 135. So there might be some slight resistance over here, but I think as long as it holds, it can hold above like the 5-day moving average, which is this blue line. I think we could still see continued strength in this counter. Yeah, then for PenU, I think it's also coming back to the resistance level for now. So yeah, so PenU rebound from the 60 cents support level over here, coming back. So I think overall still in the range for now, mainly between 60 cents to about 65.5 cents. So it might over here it might still face a bit of resistance as usual, then it might do a bit of a slight pullback. But I think overall the uptrend is still very strong. A bit just taking place a bit of consolidation taking place since late January this year. Okay. Then there's a question on Adobe. And so for Adobe, I think it's still a very strong downtrend overall. It's still within this downtrend channel. A bit of a slight rebound recently, but I don't think it will be too much. Some reasons likely to be still around 380, which is this recent this higher horizontal trading range breakdown. We look at the weekly as well. It's likely to face some resistance around 380 to 390 as well, around the 10-day MA, which is the red color line. Okay, then there's a question on the STI. For STI, if the 50 MA and 100 MA are converging, what's the significance of that? Okay, so for that, I don't think there's going to be much significance. So you're right that this 50 and 100 MA are converging with this green as well as this red line. I think mainly because when you look at the 100 MA, which is around the three months, which tracks the last 3 months closing price, right? Previously, when we saw the last 3 months for STI has been quite flat. So that explains why you can see these two MAs, 50 and 100 MA, has been going quite flat recently. So I don't think there's going to be much impact, but at this 3,850, I think this level, previously there was this quite a good bit of consolidation over here. Then there was this huge gap down because of after the tariff fear. So coming back at this level, I think probably a bit of a resistance. I think for the short term, we might see a bit of a slight consolidation might take place over here. So that's for the STI. Okay, I'll move on to some of the other questions. First one is SRT. So this is the IHS REIT sleep. So this is the IHS REIT ETF. So for this, I think a bit of a rebound for now. Still holding about 70 cents is the key support level that needs to hold. So I think overall we might see a bit of sideways consolidation with resistance around 73 cents. So 73 was the previous range horizontal resistance. So probably a bit of I think nothing much as usual, just probably be a bit of a sideways range trading might take place. And for SIA, a bit of rebound towards this previous support level breakdown. So around 670. We might see some sideways kind of consolidation taking place over here first. But if you can still remain above the 5 AM, this blue color line, then I think it's still quite strong, around 660. Yeah, so let's see. If you can hold over here for a while, then I think there's still a chance that it could go higher towards like 685, this next resistance level. The next one is venture. So for venture, I think overall it's still quite a strong downtrend, just a bit of rebound recently from this 1080 previous swing low level. Just a bit of rebound taking place for now. I will expect some resistance to come on the weekly wise. It's probably around 1180 to 1190. So that's a 10-day moving average. So just taking place just a bit of rebound taking place. 1180 previously was a horizontal level as well. So this level might have some resistance. The next is on Fraser's Enterprise Trust. So for Fraser Enterprise Trust, I think still one of the stronger REITs out there right now. So still continuing this short-term uptrend over here, breaking above $2.22 and then just holding a bit of a sideways for now. There's some reason at 228. I think if it can break above that, it could go on to test the next level at around 232. Yeah, so overall still looking quite resilient for now for FCT. Okay, the next question is on Raffles Medical. So for Raffles Medical, I think likely to do a bit of a sideways. So since price recovered of this 96.5 cents level, some resistance around the $1 mark, and then currently doing a bit of consolidation, but I think still looking okay as long as price holds over 98 cents, this 20 ME level, as well as which it broke above recently. So just doing some sideways around here. So if 98 cents can hold, we might still see price try to test maybe 103, which was the swing high before the pullback took place. And then for Yangtze Shipbuilding, I think a bit of a slight consolidation as well. So recently, last Monday, there was a gap up over here, and then prices trading sideways over here for now. Right, this prior support turned a bit of resistance around 223. Yeah, so I think overall still okay as it's still holding above the 5-day ME over here. So I think if that's still hold, we could still see a bit of a potential upside, a bit to test these two. Try to retest this 237 swing high from last week. Then next resistance will be probably around 246 about there. So just some consolidation taking place. Next question is on CNMC Gold Mine. So for CNMC, a bit of a slight pullback recently, but overall still very strong. I think support likely to come in probably around 38.5 cents to about 39 cents area, which is the 20-day MA, as well as this. It was a swing high resistance that price broke out of. So probably we might do a bit of retest and then hold as a bit of short-term support over here. Yeah. Next one is on Yangtze Financial. So for this, yeah, today there was a gap up over here, but the 73 cents resistance still holding over here, because I think previously there was a bit of quite a period of consolidation over here before price broke down. So coming back to this area, there was a bit of resistance, but I think something to look out for will be that in the coming few days, see whether the short-term moving averages that 5-day MA can hold around 69 to 70 cents area. If this is able to hold as support, we might still see this bounce continue upwards. Yeah, so since it's still just gradually holding up, trending upwards still for now. The next one is on ComfortDelGro. So for ComfortDelGro, I think still quite strong. Yeah, recently broke above 150 this level, around 154 right now. So I think we might still try to go high, a bit higher. Yeah, since still looking quite steady above 150. Next level maybe around 150 or 1 to 160 that level. Okay, and next one is on CNM's Geo Energy Resources. So Geo Energy has also performed quite well. So actually it hit the projected target level of this ascending triangle breakout at 37 cents really. So a bit of this level, a bit of resistance previously, which was a swing high back in March of last year. So we might see I think it probably might do a bit of a sideways consolidation here, but some support should come in around 33.5 cents to 34 cents area. So we might just see a bit of sideways consolidation. But if you can hold this support, then I think there could still be some chance of upside if it does break above these 37 cents again in the future. Yeah, so I think that in terms of chart, still looking quite good for now. And for Parkway Life REIT, I think still just a bit of a sideways consolidation. I think the 425, this resistance still holding quite strongly over here. And support is generally quite strong around 405. So nothing too much for now. I think the volume is also coming down quite a bit. So likely to just see, I think, more of this kind of sideways consolidation for now. Yeah, unless there's a break above this 427 again, then there might be some chance of a further upside, since it will be likely the third time that is testing this resistance within this 1 month period. Okay, next up is Semco industry. I think Semco just a bit of sideways continuing on. But positive is that since there was a bit of double bottom form at 580, then price has been just trending higher over here, like above the short-term moving averages. So if you can hold, let's say, like 630 and above, which is the recent swing low as well, then I think it will be quite positive. Yeah, a bit of resistance still for now, maybe at 650, around 650 and above to 670. Yeah, there's a bit of range holding for now. But with the higher low recently after the double turn, I think it's still quite positive. Yeah. Then for sets, I think for now it's still within this downtrend channel over here. So coming back to the downtrend channel resistance, we might still see a bit of resistance coming over here for now. Yeah, in terms of the weekly chart, I think it's respecting along the five period on the weekly as well, these two lines. So there might be some resistance at this area, I think. Yeah, when since it's a mean reversion towards this 5 M in the weekly recently. Okay, then for Samudra shipping, Samudra, I think a bit of a consolidation for over here for now, since the recovery above 79 cents. So previously at this level of around 83 to 84 cents, previously this was a support breakdown. So it's coming back to do a retest. So we might see a bit of a sideways consolidation, but if you can hold above, let's say, around 82 cents, the 10 MA, as well as the resistance level from a few weeks back, if you can hold this resistance as support, I think over time it might still continue a bit of a bounce towards, let's say, 86 cents and then 88 cents, which is the next two resistance levels. Okay, the next one is Fraser Logistics and Commercial Trust. Yeah, for this recovery above 86 cents level, and then we sort of retested the 92 cents to 93 cent resistance, a bit of pullback for now. So I think for now, see whether the support over here is 7, how cents can hold this 20 around the 20 MA as well as the 10 MA this intersection level. So over here, if you can hold, we might see some rebound, then likely to do a bit of sideways consolidation over here. And then there's also a question by Jamie, a question on Seatrium as an oil play. Does it mean that it maps the technical movement of oil? Yeah, so I think I was looking at just now, it sort of follows pretty closely. So let me just do a comparison. So if you compare to, let's say, WTI, right, you can see in terms of the chart, if kind of maps quite closely, the candlestick chart is Seatrium, and so the line chart in maroon is actually the price of WTI oil. So we see when there was an increase in oil price previously, I think back start this year there was the price follows as well. And then when oil price came down recently, also there was a decline. And today, and then also a bit of a slight rebound recently. So that's why the price went up. So I think it maps quite closely with the oil price in terms of the technicals. What's the technical outlook for WeHer after special dividend? Okay, so for WeHer, I think for now it's still holding quite well. I think generally it's a very large trading range. So around 40 cents to close to 56 cents. So it's coming back to close to this the top end of the range again. So I would expect a bit of resistance over here. Yeah, around 55.5 to 56 cents. So at this level, we might see a bit of a pullback again. Yeah, I'll take some more questions. Which is iFast. Yeah, so iFast after the sell down today. Actually, there was previously was trading within this uptrend channel, and then there was a breakdown in April, then sell down, a bit of a rebound. But today, kept down, strong selling on high volume. So I think likely we see more downside hit to maybe retest at least this around close to $6 level over here. Yeah, which was the start of this month. Yeah. Then below 6, the next key support. The next key support probably around close to like 565 perhaps, around there. So that's probably the next two key support levels for IFAS. Okay, then for Thai Bev, I think for nothing too much, still rather very sideways kind of counter. So recently I'm holding above the 50 cents key level, but I would expect reasons to be around 52.5 cents over here to be quite strong again. Previously were very long consolidation, and then price just holding recent over here. So I think expect more of a sideways for this counter as usual. Yeah. I'll take two more questions since about one. So next one is China Aviation. China Aviation price managed to break above this downtrend resistance line, also above 84 cents level. So I think we might see some sideways consolidation. 7 cents will be still quite a spear of resistance for now. So I think we might just see some sideways with support probably around 83 to 84 cents area. Okay, then for next one is OLAM. Yeah, so for OLAM, price may recover above 92.5 cents level. So we might see some consolidation over here with some resistance next close to around 99 cents, 99 cents to about $1, the psychological mark. So it might just follow a bit of trading range we've seen over here from February to March this year. Yeah, so I think that's all for the technicals for me. Sorry, I'm unable to take all the questions in view of the time. But feel free to post any questions you have in the P3 TA community group, then I'll answer it over there. Yeah, thanks for all your questions. I'll hand over my time to my other colleagues if there's anything to add on.
Yeah, I think we hit the time. I'm not sure if the rest can just quickly wrap up on the SGX and BHR. Yeah, just very quickly.
Yeah, so for current SGX price, yeah, it has run up recently. I mean, not recently, but it has run up, mainly due to the trading volumes, which have actually boosted will boost their revenue. So we haven't really seen, we won't be able to see how much it has impacted their revenue, but we believe that this trading volumes, and mainly due to volatility, will really improve most exchanges and brokerages as well. Yeah. Yeah, Ben. Sorry, Iqbal.
yeah. Oh yeah, okay. Just a bit on WeHer. Yeah, I mean they are giving out special dividends of 7 cents. So this coming Wednesday they'll be holding the AGM. Yeah. So I mean in theory, if they after they give out the 7 cents of special dividends, the chart supposed to get down by 7 cents. In theory, yeah. But we'll see how it plays out. Yeah. Thanks.
Okay, thanks. There's one question for Q&A. Can you show the questions in the screen during your answer? Yeah, I think that's a good idea. We will try our best. We're not sure actually how to do it, but we'll try and put the questions on the screen. Maybe hopefully then everyone can see and maybe get better clarity. For the Keppel Infrastructure Trust, I need to get back to you because the details very hard to iron out. They got so many business, but in general we are still negative because I think the distribution income, even if you exclude the one-off, it is down almost 30%. So they did well last year because there were some one-off gains that they paid out. But I need to get back to you on Keppel Infrastructure because it's a very complicated company, very hard to wrap my head around the outlook for this company. So apologies for that. But in general, we are generally negative on it. Thanks. So with that, I'd like to thank everyone for your time. Sorry we overran to one. Hope it was useful, and thanks again for taking the time to be with us, and hope and wish everyone a good week ahead. And thanks so much again. Bye bye.